Let's get into the best way to set a stop loss when investing in the stock market. Now, stop loss sounds fancy, but it's very simple. It's just where you are going to exit your investment, where you're going to sell your stock. And why are we even talking about this? Well, risk control is the most important part about investing. And knowing when you're going to sell, when you're wrong, and when you want to cut off those losses, that's extremely important. My favorite Buffett quote is his 2 rules of investing. Rule number 1 is don't lose money, and rule number 2 is don't forget rule number 1. Controlling your risk and cutting your losses with something like a stop loss, that's the only way you're going to be successful in the stock market in the long term. Because regardless of what your strategy is or how you invest, you know this is a long-term game. And what happens to a lot of people? They do well for a few years, but then a few years down the road, they get blown out. Why? Because they didn't control their risk. And once you get blown out, you got to start at zero again. It's the worst position to be in, which is why the guys who truly compound their wealth year after year for 30 years or even more, they are the ones controlling their risk. Because we know that the reality of the stock market is that you are going to lose. But guess what? With something like a stop loss, you get to control how much you're going to lose. Some of the greatest investors in this game, they only have win rates on their trades of 30%. So 70% of the time they're actually losing on their trades, but how are they making billions of dollars? Well, again, risk control. They manage how much they lose. So they lose very little, and when they win a lot. So the few wins completely wipe out all the losses. And by using something like a stop loss to control those losses, you're able to take a lot of them. And like I said, in the stock market, we all take a lot of losses. That's just how it's structured. Mr. Market is very cruel. So that's why that old trading adage is there. Cut your losses and let your profits grow. And the best way to cut your losses? With a stop loss. But if you clicked on this video, then you likely already know that. That's why you clicked. You know stop losses are important. So what is the best way to set a stop loss? Well, we are going to go over 3 different ways, and we're going to talk about the differences between them, and then finally, which is the best. So the first way to set a stop loss is just to set a standardized stop loss. Well, it's very simple. All you do is set a percentage that if your stock drops that much, you are going to exit. And you can keep that the same across all your investments and all your trades. So one fantastic book from a legendary market wizard, William O'Neill, is How to Make Money in Stocks. And in this book, he gives you the full strategy that he uses. And once you read it, you'll see that many successful investors use this same strategy. And of course, this strategy comes with how to set a stop. And the way he does it is this standardized percentage. So he says if your stock falls 7 to 8% from its entry price, exit. And that's it. It's very simple. You're picking a percentage and you're just standardizing it across every one of your investments. Now, the percentage you pick, you don't have to get too complicated with that either. It can be 7, 8%, 10%, 15%. Obviously, you don't want something like 50% because that's pretty crazy. That's too much to lose before you jump out. But you can basically pick whatever you feel comfortable with. Now, my suggestion would be to extend that percentage as much as you can and still be reasonable. So you could pick 1%, right? If this thing falls 1%, I'm getting out. But guess what? The smaller you make those percentages and the smaller you make those time frames, because things can fluctuate 1% in a day, right? Individual stocks often fluctuate way more than that. Well, you're going to get knocked out a lot more. So that's why William O'Neill, he said 7 to 8%. In our Fallible system, we say 15% because that gives it some room to move. You know things get volatile, right? Especially the smaller time frames that you go down into. So if you're looking at your stock day to day, it can go up 3%, down 3%. So you don't want to get knocked out right away if your stop loss is at 1%. So going back to our Fallible system, we do this same thing. We set that standardized percentage. Ours is 15%. So if any of our investments, when we get in, if they fall 15%, we get out. That's our stop loss. And the beauty of having that standardized percentage is it lets you standardize everything. So I told you we use a Fallible system here, like myself and a lot of our Fallible members. So that's a trading system that's fully automated and everything is standardized. So even when we're picking stocks, we use this TSI scanner right here that tells us the momentum of the top stocks in the NASDAQ. It spits out this little number and we know which stocks have the most momentum, so we know to invest in them. And every month we rotate into these top 5 stocks based off this reading. So it's very mathematical, very standardized, and that's why our stops are standardized too at 15%. And the nice thing is when you have all these things standardized, including the stop, we also have targets where we'll take profits at a certain percentage. Well, you can take that set of rules and back test it. So going back 10, 20, 30, 40 years, you can see how this set of rules would perform. And that's how you get a system that's successful like our Fallible system. You can see right here, this is our equity curve in the market and this is the NASDAQ. We do way better, 3 times better. So it's not a bad idea to standardize and it makes things a lot easier. And you'll see why when we get into the second 2 ways of how to set a stop loss. Now, the downsides of this, one of them we already explained. If you set that stop loss too short, you don't want a little tiny one. And another downside is that that specific stop, it might not mean anything for a certain stock. It's just arbitrary. So here's an example of a stock, Applied Materials. So say you got in right here and say your stop is at 20%. Well, 20% is around $109. And what does that really mean for the stock? There's no real technical pattern here. There's no fundamental reason. It's kind of just like, okay, it dropped 20%, let me get out. So sometimes this will work and other times it'll be like, well, why did I get out in this like dead man's land? So I should have got out up here or I should have got out down here. Why here? But again, we just set a standard percentage, right? 20%. So sometimes when that happens in investment, you might be like, well, that was stupid. But again, it depends on your total strategy, because at the end of the day, just getting out is a good idea. The fact that you cut your loss somewhere is better than not doing anything at all. But with this type of stop loss, you got to be ready for that. Now, the second type of stop loss you can use, you're going to have a big reason to get out. And this is the fundamental stop loss. So what does that mean? Well, say you're looking at Disney right here and you bought the stock and it's going up nicely. But then all of a sudden news comes out that somehow Disney lost their rights to Marvel. They can't make any more Avengers movie. That X-Men movie that we all wanted never comes out. Now, this is just an example. I don't know why Disney would lose those rights. It's not like a slip of paper that you lose when you're walking to your next meeting or something. But let's just say they lost the rights. Well, in that case, regardless of what happens to the price of Disney here, if your fundamental thesis was based off Disney owning incredible IP like Marvel, Star Wars, and all the Disney princesses, well then that just changed, right? They just lost Marvel. So your thesis is broken. And what do? You exit the stock. Now, losing Marvel might be a little drastic, but the idea is that any news flowing out of a company, if it doesn't fit your thesis, you might want to get out. That's a fundamental stop, because that is telling you that the stock is not going to go to the place where you want it to. That's if you are a fundamental investor, because here's the thing with all these stop loss methods, they need to fit into your overall strategy. So if you're a technical trader using a fundamental stop loss, that doesn't make much sense, does it? Same if you're a systematic trader like I am. Like, you would not care about the fundamentals. It's all numbers. Another example is just an earnings report, like Disney just reported a few weeks ago, and they surprised, they beat their earnings. Now, does this mean you stay in the stock? Maybe. It depends on what you're looking for. Maybe they didn't beat their earnings like you wanted them to. Maybe they missed in a key indicator that you were looking at. Their margins weren't as good as you wanted. But this is a huge fundamental piece of news that comes out every quarter, right? And you get to analyze that, and it will tell you whether your fundamental thesis is on track. If it's not, there's your stop loss. Get out. And here you see Disney bounced after that earnings report. Well, it went down for a few days and then bounced, but that shouldn't matter if you're doing a fundamental stop loss. So the point is that you're getting out of the stock once your idea and thesis is invalidated. And that works on the fundamental side, but it also works on the technical side, which is our next method of a stop loss. And this is probably the most popular one. So the same thing here, you're trying to get out of a stock once your thesis is invalidated. But in this case, because it's a technical stop loss, you're talking about technical patterns in the market. So most of the time when you set a stop loss technically, you're looking for a breakout, you enter, and then if the breakout fails, you get out. So I could give you an example right here with Peloton. Let's say that it was forming a nice little cup pattern right here. Now, of course, this is all easy to look at in retrospect, but let's just say this plays out. So you're looking for this cup pattern and you want the breakout, and hey, you got it. So you get in right here. And what happens the next day? It shoots up even more. Amazing. Now, what you're looking for as a technical trader is for prices to stay above this breakout level. So what you can do is extend this line past the breakout, and you can call this whatever you want. We called it a cup, but really that's up to your strategy. But what you can say is that, hey, if it breaks below this line, I'm going to get out, because that means the breakout failed. So you extend that line and you're waiting for it to either take off from there or fall back. And sure enough, what did Peloton do? It fell below it once again. And you can see it treaded sideways after the breakout, and then a few weeks later, it's breaking below. And as it breaks below, this is the stop loss right here. This is where you exit. Now, where you set it, again, that's up to you and your strategy. So say you got in around 143. Well, you could set a stop loss right around 133. So what's the percentage there? Say around 143 to 133, it's like 7%. Now that kind of lines up with the standardized percentages we were talking about before, but you see it's different because it's based off a pattern. The fact that Peloton popped and then fell, meaning it did not hold its strength, it's telling you that you were wrong. And this way you only lost 7% because you were wrong. Now there's a few things that you want to realize here, and this is where it gets kind of tricky and it becomes discretionary and it's kind of a bit of a mess, but you can kind of standardize a bit too. So say you wanted to exit, right? If it breaks this line, well, one of the difficult things is how much does it need to break the line? Because look at this right here. It broke down, but then it popped back up towards the line because these lines aren't perfect, right? So if you ignore what happened afterwards, this thing could have just fell below for a day and then rocketed higher. In this case, it didn't, but in many cases, you will see that happen. So that's why when I said maybe we could set a stop at 133, you see it's below that point because I didn't want to get shaken out. And that's something that can happen. You can get get your stop losses ran because everyone's looking at the same levels. So the algorithms can go dip below that point and then rocket it back up once you sell. All these games in the market, it sucks sometimes. So you want to keep that in mind when you're setting your loss. You got to kind of play the player. If everyone is setting their losses in the same place, again, they could run those stops. When I say losses, I mean stop losses. So try to set it just a bit below that so you can still have your risk control in place and still get out generally where you want to, but you don't get toyed with. Another thing to notice is look at this bar right here. You can see its wick goes down below, right? So what that means is that in the middle of the day, the stock actually dipped below this line that we're watching, but you can see that it didn't close below. It closed right on it. That's another thing you want to watch. You might not want to get out of your stocks on an intraday basis, and that just means within the day. You might want to wait for a close, because what did we just talk about before? The smaller you go in time frame, the more noise you're going to get. Within the day, stocks can go like this just all day, right? But the actual close at the end of the day, that's a stronger signal. That's what people are going to hold into the night. So that's why you could see things dip like this and then close above. See, it kind of held its point. And again, if you ignore what happened, this could have rebounded from there and took off. And you would have been happy, like, oh good, my stop didn't get ran because I waited for an actual close. So the actual close is going to be a better signal. Another good example I wanted to show you is this current pattern in Bitcoin. You can see where this support line is clearly, right? Because all these wicks are dipping below. That means that prices are actually closing on this line. Well, if you set your stop loss right on that line, you would have been shaken out right here because this fell below, but it actually closed pretty close. And I was looking at this stock on June 8th and it was all the way down here and I'm like, oh, this pattern is broken. But sure enough, by the actual close, it was back here and now it popped the next day. So you could see how that intraday action, it can get you in trouble. So you really got to be aware of that and also where you're setting your stop, because remember, at the end of the day, these are just lines. Like, it's not going to be perfect. They might dip below and above. Just like here, we could look at the S&P 500, the SPY ETF. Some people like to set their stop losses below moving averages. So this gold line right here is the 50-day moving average. Well, look what happens. You can see in certain areas, it dips below and then rebounds back. If you got out here, you'd be a little annoyed because the stock took off without you. Now, sometimes that'll happen regardless, but other times you might be able to adjust where your stop loss is so you don't get ran like that. So in this case, what I used to do is I would take this 50-day and turn it into a 65-day. Now look at it. These prices are barely breaking through. So by extending the time frame a little bit, I'm kind of avoiding all the stops being run. And this is what I used to do as a discretionary trader. Because the truth is, does it really matter if it's a 50-day or a 65-day? As long as you set something and you stick to it. Now, of course, while you're doing this, while you're trading, you don't want to keep extending this moving average here. You don't want to go from 65 to 75 to 85. You generally want to stick with one. But each thing trades differently, right? This SPY is going to trade differently than Bitcoin, which is going to trade differently from Peloton that we're looking at before. So based on the behavior of a chart, and you can go back, you could see how it behaves, you could set different moving averages. And based off those moving averages, you could set your stop losses. It's a little more complicated, but it works. And remember, if you want to have a better signal to noise ratio, then you're always going to want to zoom out so you don't get shaken out. So this whole Bitcoin thing that we're talking about, same pattern. Let's zoom out from daily charts to weekly charts. Look at that. Looks a lot clearer what's happening, right? The consolidation. And you can see that these candles are closing well within the range and that it's just the wicks going down below, because guess what happens when you move into the weekly time frame? The wicks are just the interweek stuff. So it could be a whole day below, but at the end of the week, where do they close? Because just like the end of the day close is a strong signal because people are holding overnight, the end of the week close is even a stronger signal. What are people doing on Friday? What are they holding going into the weekend that they're willing to hold into Monday's open? Because anything can happen, right? That's a few days for news to come out. So when you're setting your technical stop losses, remember, you could also zoom out to the weekly time frame, and the closes there are going to give you a much better signal. The further you zoom out, the better off you're going to be in terms of not getting shaken out, because that's something we got to watch out for when we set stops in this technical manner. So now you got the 3 ways to set your stop loss. Which is the best way? Well, the truth is there is no best way. The best way is whatever you choose that fits your strategy. Like I said, you can't be a technical trader using a fundamental stop. I personally don't even use a technical stop because I'm using a systematic strategy. So my stops are just at 15% no matter what. I can't screw with the system and try to use a technical pattern to get out of a stock because it wouldn't make sense. How am I supposed to backtest that and apply that to every trade that I make over 40 years? I can't. But that doesn't mean it's not good. I used to use it. I used to be successful with it. The point is that you use a stop loss in the first place. Again, there's no perfect way, just whatever you feel comfortable with. Just like when you pick a strategy, there's no perfect strategy. It's just whatever one fits with your personality. So for me, I would never use a fundamental stop loss because I'm not a fundamental trader. It would drive me crazy, but it does work. So just pick whatever works for your strategy. Remember, if you're managing your risk, that's the goal. sold. Now, if you want to know the best way to actually enter a stop loss order and go into your brokerage and do that because you have to, then check out this video right here. We break down all the order types and the best ones to use because there are so many now and it does get confusing. And picking the right order type makes setting a stop loss so much easier. So if you want to make your life easier and make more money, obviously, because that's why we're talking about the stock market, then watch this video right here. Click it and I will see you over there.